Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, how you can collect a premium upfront, and how you can generate consistent returns year on year. So the first thing you need to do is open up your brokerage platform. I'm using Tasty Trade. You can use whatever you want. We're going to be writing contracts, options contracts specifically. So we need to know where we are in the options cycle. So you just want to pull up any underlying. We've got UAL up at the moment. We've got a position on. And you just want to have a look at a list of expirations. We can see we've got weeklies and monthlies. Obviously, the weekly is the one with the orange W, and the monthly is everything else. So the first expiration is a monthly. We want to stick with monthlies. We don't want to do weeklies for the purpose of what we're going to be going over in this video. So the first one available is October 18th. That's 1 day away. It's far too close. We want to be between 30 and 60 days out in time. The next one down from there is November 15th. And we've got 29 days left on this contract. That is still too close to us. We are kind of in a transition period right now between November 15th and December 20th. As you can see, 29 days and 64 days. Neither is ideal, but you just have to pick one if you wanted to be efficient with your capital and not waste time, basically. So if this was me in this situation, I would be lenient. I'd be leaning towards the December 20th expiration. November 15th is a little bit too close, although if you did pick the November 15th, you wouldn't be wrong for doing that. It's just preference at this point. So 64 days, we know we're going to be 64 days out in time. Now we want to just pull up a watch list, and we want to filter out anything that has earnings over the next 64 days. And the reason for this is simply because we don't want earnings to disturb our trade. It's that simple. Earnings will increase vega or volatility. It will mess up your deltas, and both of these things are going to have a negative effect on your P&L. So we want to avoid it. And we also want to filter out anything that has a low liquidity level, because we want to be able to get in and out of positions easily, and we don't want to be paying wide spreads. We want tight bid-ask spreads. Every time we get in or get out, we're paying the spread. So the tighter the spread, the less we pay. We want everything to be liquid, so we want to filter out what is low on the liquidity level. So what's left is a list of things that's very liquid. Everything here doesn't have earnings, and finally we just want to order everything from high to low IVR. We want to sell or short when volatility is high, play the contraction, and then buy back at a lower price further down the line. That's how we make money in this game. Volatility is a mean reverting thing, and you'll be fine long term. Just stick to selling in high IV. So anything with an IV rank of over 50 is considered high. However, sometimes things over 30 can also be considered high as well. Generally speaking, you want to stick with something over 50. And as well as the IV rank, you also want to look at the actual raw IV value, because IV rank is one thing. For example, if you have a look here at SLV and crude oil, both have a very similar IV rank, but their actual raw IV levels are different, and that will be reflected in the premium that you collect and the risk that you will be taking. So with that in mind, you also want to keep in check with what you also want to don't overdo your portfolio in any one sector, right? Keep it diverse. You can use beta weighting. You can look at your correlation with SPY. You could do all this kind of funky stuff. That's great. That's fine. Do it. But if you want to just really simple, use your common sense. If you've got loads of tech companies, don't look at more tech companies. If you've got loads of precious metal stuff, don't look at more precious metal stuff. Look at something opposite. Look at, there's so many sectors, right? Just use your common sense and don't be too heavy in any one thing. And if you really want to take it to the next level, you can use correlations with SPY. If you really want to take it to the next level even further, you can just beta weight everything. Tasty Trade makes it really easy to look at your beta weighted deltas and whatnot. So with that being said, but that's all advanced, don't worry. Just use common sense for now. And if there's a brand new portfolio for you, then you can pick whatever you want, basically, if it's your first position. So SLV is at the top. We like SLV. SLV trading at just under $29. The cheaper, or not cheaper, the less that something trades for, typically the less premium you're going to get. obviously the less buying power that's going to be required, because obviously it's a smaller product. But $29 is kind of on the edge for me. I like to be $50 and up to be able to get a nice, respectable um, premium, and to also have nice strike selections. Um, but by all means, if you've got a really super small account, you could have a look at SLV. I'm just going to keep going down. I'm going to have a look at, we've got GDXJ here, we've got XLU here. Let's have a look at what else. This has an IV rank of 112. That's the VIX. That's fine. We don't want to trade that. And you just wanna basically scout, and you just want to go through different watch lists and just have a look. Just see, there is no right or wrong answer. Just see what tickles your fancy. Um, and the real skill is gonna come next once we've picked something. I don't really like this watch list. Let's go to Tom's watch list. Tom's watch list is usually quite a good watch list. I like it. And if you have a look here, WFC, Wells Fargo trading at 64. This just stood out to me here. We've got a raw IV level of 31%, IV rank of 50.5. I like this. WFC, we're going to have a look at WFC. And of course, we're going to be over at the December 20th expiration. And now we are presented with a list of expirations. The horizontal orange bar shows you where price is currently with respect to the rest of the strikes, and the vertical orange bar shows you what the expected move is of Wells Fargo, or of the underlying, over the next 64 days. So how do we make money from this situation? We've spoken a lot and nothing about how to actually make money. So how do we do it? We need to sell or write some contracts and collect a premium in return, like an insurance company. So what are we going to write, and where are we going to sell it? So there's two types of contracts, calls and puts. We want to sell one call, one put. Very simple. Where do we want to sell them? We want to sell them outside of this expected move, because we want a high probability of success. Think about it. When you buy car insurance, they know the chance of you claiming on that insurance is very low, but you pay the premium anyway. And this is just a proxy for us to just collect premium and be insurance companies. And when it comes time to pay out, we manage risk and do everything we can to not pay out. Basically, that's the game in a nutshell. So we want to start off with a high probability of success, and we do that by going outside of the expected move. How do we do that? The further you go out past the expected move, the less premium you're going to collect. So there is a sweet point, a sweet spot, and for me, that's between 15 and 20 deltas. So if we go on the call side, we look down the delta column, we can see we've got 15 and 24 delta. I'd be tempted to go with the 15 delta. On the put side, we've got a 15 and 24 delta again. Let's just go with the 15 delta. And that's it. That is literally it. That is the position that we're looking at. This is called a strangle. It's a naked position. We would sell one contract at the 57.5 strike, one contract at the 72.5 strike, one call, one put. And we've essentially created a range. And if you have a look, our contracts are sitting outside of the expected move, but not too far outside the expected move. They're actually sitting at about at the one standard deviation mark. Okay. And if we were to plot this on a graph and see what this would look like, we'd plot price levels at 57.5 and 72.5. So let's just do that now. There we go, 57.5 and 72.5. So we've essentially created a range for ourselves. And what we want to happen is we want for price to stay within this range. Okay. And if price stays within this range, then if price stays within this range at expiration, we will keep 100% of the premium that we collect. The premium that we collect is $1.17 per share times 100 shares per contract. That's $117 we would collect up front. We collect that up front, and as long as price expires within this range, we keep all of that premium. We don't need to pay anything out. Okay, and now what is the likelihood of WFC staying within this range? Well, we can see that here down below with the probability of profit of 73%. So you got a 73% chance of price being within this range in 64 days time. But there's an even more interesting number here next to the P50. That means the 50% of profit. So if we were to get out of this position at say $55 to $60 of max profit instead of the whole 117, then we've actually got a 92% chance of hitting that 50% mark at some point between now and the next 64 days. So we're looking at between a 73 and 92% chance of success. These are very, very high probabilities, right? And you might be thinking, well, if you have a very high probability of success, then you're probably not getting a very good return on capital. That's a valid point. So if you have a look here, we'd collect 117. Our broker is going to require 646 in buying power. So this is actually a very nice return on capital trade, especially for a naked position. Naked meaning that there are no longs covering the shorts. These are shorts because we're selling them instead of buying them. We're going to buy them back at a later date. Or they'll just expire worthless. So this is a naked position. We have an unlimited loss potential. And if this is too much for you, I would be tempted to just leave this as a naked position. But if for whatever reason this was too much for you, you can just buy another contract a little bit further out. $2.50 wide on either side. And as you can see here, our max loss is no longer unlimited. It's now defined. It's defined by the range minus the premium that we collect, because nobody can take the premium away from us once we collect it. And what's left is our max loss, and that's what the broker will require in buying power. So you can manipulate positions to fit your needs. And one other thing to keep in mind is that you now have a lower probability of profit in doing this, but you have a higher return on capital. So that's your trade-off. There are some other nuances as well, but generally speaking, that's your trade-off. So that's how you can find positions and manipulate positions. You also need to keep in mind the size of your positions, because it doesn't matter what you do, if your sizing is wrong, eventually something's going to happen. It's going to cause you to get margin called. So the way you avoid that is by using a position sizing template. And we've created one here that's free for everybody to use. Link is in the description. The way it works is you enter in the size of your portfolio. Let's just say if it's $10,000. Below that, you can then enter in what the current VIX level is. Say if it's 16.3. Everything below will then be automatically calculated for you. And at this point, all you need to do is simply use the information to form the backbone of your portfolio. And over the long term, you will be just fine. It explains everything. Again, link in the description. Click on free position sizing template and it will take you to where you need to go. If you would like to learn in more depth and see what we're doing inside our portfolios, get live updates on positions, adjustments, etc., link in description. Click on EDS Premium, get yourself signed up. Inside, you will have access to our portfolios where you'll be able to see everything that's happening. And there's a full course, so no prior knowledge is required. We will teach you everything you need to know. This allows you to learn and earn at the same time. If you get stuck, it is a private community, so you can speak with like-minded individuals or with myself directly. And currently, because we have just started, I am offering complimentary one-on-one onboarding calls for the first couple of people that join. There is a 100% money-back guarantee. So once you've studied the full course and followed our trades and positions and adjustments for 6 months, and if for whatever reason you haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part. Right now, it is £1 a month to join. Once you're in, you don't need to worry about price increases. The price will be increasing. Like I say, you don't need to worry about that once you're in. And with that being said, I will see you guys on the inside.